Hey everybody, welcome to our weekly Wednesday webcast. Today we're going to talk about how to know when to pivot or sell your company. So I want to cover three key areas today. Number one, I want to talk about the history of fit tech. Number two, I want to talk about the growth behind two really cool fit tech companies. And number three, I want to talk about the future of fit tech. So it was in 1939 that Jack LaLanne created the very first health club in the US. He launched his studio in Oakland, California. In 1965, Joe Gold created the very first Gold's Gym in Venice, California. And in 1982, Jim Plunkett of the Oakland Raiders created the very first 24-hour fitness in San Jose, California. So I see a little bit of a trend here. It's always California, it's always men. It wasn't until 1982 that Jane Fonda came out with her first workout video, Jane Fonda's Workout, which we all know what happened with that. It was a huge success. And in that same year, Jenny Greggins came out with her morning stretch show, which was also a huge success. And of course, we can't forget Olivia Newton-John in Let's Get Physical, which was circa 1982. So it was a big year for women. And if we fast forward to 2018, we see that there's tons of studios that are owned by women. And in fact, more than 50% of gym memberships are held by women. So we definitely have a presence. SoulCycle was founded by females. Flywheel was founded by females. And of course, there's thousands of others. So if we look at this market, globally, it's an $80 billion market. In the US alone, it's a $25 billion market. In fact, more than 55 million Americans have gym memberships to the over 36,000 gyms that exist in the US. So if we look at those numbers, the average revenue per user is about, we can call it $40, $50 per month. And that's increasing all the time. And I would say that the highest number per members is actually Planet Fitness. They have 7 million members. And they have about close to $375 million in revenue per year. So if we crunch those numbers, average revenue per user for Planet Fitness is about $5. So it's definitely on the lower end. And it's important to note that most gyms have a 60% dormant rate. So 60% of Planet Fitness's members could not be coming to the gym. So it doesn't matter that they're paying $5 because they're paying $5 to use 0% of their resources. So on the higher end, we have more of these boutique studios where it can be $20 to $35 per class, and the monthly memberships can be $300 to $500 per month. And in fact, IHRSA has said that $8 billion of the $25 billion market is going to these small studios. And that brings us to the two companies I want to talk about because they are targeting this market, boutique studios. The two companies are ClassPass and MindBody. So let's start with ClassPass. Really fascinating company, and they didn't always know they were going to be focusing on studios. What happened was the founder, Payal Kadakia, was wanting to take a dance class and couldn't find one. And she thought, wow, this is a big problem. I should solve it. Smart girl. So she said, okay, I'm going to create a search engine. And she created it, but crickets, got tons of good press, but nobody was really using it because it wasn't a problem that people really felt they needed to find a solution to. So what did they do? They went and they talked to the studio owners and figured out what was the big problem the studio owners were having, and it was getting people in the classes. So if you're a studio owner, let's just say you pay $50 per instructor to teach the hour class. Let's just say it costs $10 to take class and you have only 5 students. You're just breaking even. So you're not paying for rent, you're not paying for electricity, you're not paying for marketing, which they generally don't even have marketing. So it became a really big problem. So that's when they had to pivot. So they pivoted from being a search engine to being a place where you can actually get a reservation. In their first pivot, it was called Passport, and it was $49 per month. It allowed you to take 10 classes. Now, the problem with that is that most classes are, $20, $30, even $35 per class. So they were actually losing money. And another part of this was that people were gaming the system. They were signing up for a Passport, paying $49 per month and essentially getting $5 classes. And then once that maxed out, they were going ahead and signing up with another email address and so on and so forth. So they had to fix that system. So what they did was they pivoted to $100 for 10 classes. And another pivot was they created a subscription model. So to put this in perspective, when they had this reservation system, within the first 6 months, they had 20,000 reservations. When they shifted to the subscription model, the first month, they only had 35 people sign up. The second month, it was 70 people, and the third month, it was 150. So that just goes to show you, sometimes you might be on the right track, but it takes time to get traction. So they made the right choice by going to the subscription model. So I would actually say this is probably their last pivot. They've been doing some other innovative things. They actually have gone out and expanded into cryotherapy and other things. They're trying to do something with they're calling it wellness, but it's essentially beauty. So they're doing, hair and makeup, those kinds of things. So they're trying to pivot again. They're trying to expand their offerings, but I think they're kind of on their last pivot. If we look at their numbers, we see that in beginning of the year, Q1 2015, they had an annual run rate of about 86 million. And in one of those months, they had 5 million in revenue with 600,000 reservations. So that's about $8.33 per reservation. So if they're selling these $100 passes for 10 classes, they should be getting to break even $10 per class, but they're not even getting that. And the way that ClassPass makes money is they actually charge, of course, the person who's using it, but they also have to pay 50% to the studio owner. So let's just say, for example, these classes cost $20 per class. They have to actually pay this gym owner, the studio owner, $10 per class. They're just breaking even with this system. So if we're looking at their numbers and their revenue per class is $8.33, that just demonstrates that the system is actually broken. And here's probably why. So some of the studios Barry's Bootcamp is a good example of a studio that doesn't pay the 50%. I've heard a rumor that Barry's Bootcamp only pays like 10% of the class fees, like $3.50. And that's why they're losing money. So I think that although ClassPass is very innovative and they're solving a really big problem because they are essentially the customer acquisition strategy for these studios, the numbers just don't make sense. So I think they're going to go on to another pivot. And I think that next pivot is they're going to get acquired. So I want to talk about this MindBody, the second company I want to talk about, because I see them as an ideal acquisition acquirer for ClassPass. So let's go ahead and take a look at their numbers. So if we look at their numbers here, we can see how they're making money. Their monetization strategy basically consists primarily of monthly subscriptions and payment processing fees. So we see that monthly revenue per subscriber growth fluctuates, but then pulls back up. The payments volume also experiences a slight drop, but it's nothing really severe. But however, it's the subscriber growth that's really concerning. So why would subscriber growth decline significantly? So more than likely, it has to do with the fact that the number of specialty boutique health clubs has been tapped out. So remember, your growth is going to taper down as the target market is saturated. We saw this last week with Indeed, and at a certain point, a company will max out on their current offerings and their target market. So you can either enter into new markets, you can go global, or you can increase your offerings. Let's take a look at some of the ways that MindBody's acquisition strategy is trying to increase their offerings. So we can go ahead and look at this next chart. April 2013, their target was Jill's List. This was helping them get into the wellness segment. They paid $4.6 million for this company. In February 2015, they acquired Fitness Mobile Apps, and this helped them do mobile apps. They paid $7.5 million for that company. So essentially helping the studios that use MindBody's software, which is basically like an ERP software system, allowing them to get mobile apps set up. September 2016, they acquired Heal Code, and that allowed them to do websites and widgets. They paid $6.1 million for that company. So basically, if you were a studio and you're on the MindBody platform, you can get a website created and also a widget, so you can go ahead and put the MindBody schedule on your website or on your social pages. In March of 2017, they acquired Limber, which I think is probably one of their most interesting acquisitions. It's a dynamic pricing modeling. They paid $7.3 million for this company. So basically how it works is if I'm a yoga studio and I only have 5 people in a class, but I can take 30 people in that class, I'm going to deeply discount that class because I want people on my website or on ClassPass or however they're finding me, I want them to go into that class. But let's say I have a class that's jam-packed, there's only 2 spots left, and I want to keep those 2 spots for my loyal members. I'm going to jack the price up so nobody else can get on there. Maybe the price would be higher on ClassPass, people wouldn't get on there. So that's why I think this is probably one of the most interesting acquisitions, because it allows them to really maximize the spots they have in classes. And the next one is February 2018, they acquired FitMetrics, which is performance tracking system. So if you've ever been at a gym and you put on the heart rate monitor and then you look at the computer monitor while you're in class and you're watching your stats, that's basically what FitMetrics does. They paid $15.5 million for this company. And their largest one was this year, March 2018, they acquired Booker. And this is really interesting because this allows them to get into salons and spas. They are now targeting that market because, as I was mentioning before, their growth is declining because they've tapped out of the small health studios that used to be very abundant, who are now going out of business. They paid $150 million for this company, which was like a 6x revenue multiple, which is pretty good. So how is this affecting their financials? Let's go ahead and take a look at this next chart, and we'll take a look at their financials and kind of how they're doing. I would say that this company, it's actually, I didn't mention this before, but it's a 15-year-old company. So you can see that they definitely have been around for a long time. So we're looking at the years there. So we're talking, in 2012, we're actually talking about year 12. So we see that revenue growth has decreased, but keep in mind, this is an older company. It's not a startup. Their gross margins have really improved over time. And that's a really important thing to look at as a company is scaling. The R&D, research and development, is about the same, which is to be expected for a technology company that's continuing to innovate. They just released Visual Workout Builder, which is another way to increase revenue per subscriber. So basically, if I'm a studio and I have a MindBody account, I'm going to pay like $150 per month to have their software. But then Visual Workout Builder is another add-on. So maybe it's like another $100 per month to use the Visual Workout Builder, which is a really cool system. Their sales and marketing remains consistent as they continue to market new offerings. Now, generally speaking, a 15-year-old company, their sales and marketing as a percentage of revenue would definitely decrease because people would know more about their company. They wouldn't have to advertise so much. But because they're constantly making acquisitions, they're going into new markets, they have new offerings, they have to constantly be putting more dollars to let people know what they're doing. Their general and administrative is fluctuating a little bit, but not really a lot. I would say that this little blip we see in 2015 was more to do with the public offering that they had in that year. So overall, the company continues to operate at a loss. However, I would say that the company continues to innovate, so that's probably a really important part of balancing out that story. I know that the CEO had predicted that the company would be profitable by now. This was like 6 months ago he was predicting this. But my guess is their recent acquisition spree has interfered with that objective. And I would say that the most interesting thing about this company is that they only raised $28 million in their first 11 years of business. And all in, they've only raised $104.5 million in the 15 years of business. So the two co-founders end up owning 19.1% of the company at their IPO, with the main founder, the original founder, Rick Stolmeyer, owning 11%. And this is really remarkable for a 15-year-old company, that this is what happens when you have discipline and you don't raise tons of outside capital. So this brings us to our last segment I want to talk about today, and that's really about the future of fit tech. Whether you work out at a gym or you don't work out at a gym, it's really interesting to know that the evolution of fitness technology has to do with consumer demand. So consumers are very, very fickle. If you're running a consumer-facing company, you know this. If we look back at the fitness industry, you can see that it was the Step came out, and then that's no longer popular. The Glides came out, that's no longer popular. Bosu's came out, and that's no longer popular. It's like constantly evolving, and that's how consumers are. If you're running a consumer-faced company, you understand this. So, and you have to constantly be thinking of new ways to make them happy. They're always looking for new playgrounds. This is why the studios were so popular, because it allowed people to go to different playgrounds, right? They're looking for new toys. That's why, the Step was popular, the Bosu was popular, the kettlebells are no longer in. CrossFit was fun for a while, and everyone's bored with that. Now it's water rowers and treadmills, and people will be bored of that in a few years. So this is where I think fitness technology gets interesting, because I think that what FitMetrics has done with the visual workout builder that I mentioned earlier, it's this really cool technology that they're using, is that they're creating new ways to make your workouts easier. So whether it's the heart rate monitoring technology or it's a visual workout builder that allows you to see your workouts, these are just ways that are where technology is making your workouts a lot easier, a lot funner. So I'd love to hear what you have to think. What are some ways that you'd like to see hardware and software companies tackle the fit tech problem? As you're working out, you're doing your daily workout, what are some things you thought, wow, I really wish there was an app for this. I really wish there was technology to make this a lot easier. I personally think this visual workout builder is brilliant because it actually gets rid of the instructor. If you think about it this way, there's companies who already are doing this, where they're creating the systems where you can actually walk into a room, press a button, and the class just starts. Peloton cycling is a good example, where they're kind of getting rid of the instructor. And this is what we're seeing a lot in the tech industry with automation, more robotics and automation, where we don't actually need the people working in the warehouse if we have the robots. So in the fitness tech industry, I think that we're going to see more of this, getting rid of the instructor. Why do you need to pay $50 per hour to an instructor when you can just put on a visual workout builder, or you can put on a robot and teach the class? So yeah, I'd love to hear what you're seeing in the fitness tech industry, and I'd love to hear what you would love to see in the future. And if you have any questions for me about anything we talk about in the weekly Wednesday webcast, my email is super simple. It's just my name, Lili at financeforentrepreneurs.co. I'd love to hear from you. If you want to go deeper and understand more about any of the companies we talk about during the weekly Wednesday webcast, 30 Days of Mentoring happens 4 times per year. We go really deep, and you have access to all the research that I do on any of these companies. If you want to see all the numbers behind ClassPass or MindBody or any of the companies we talk about, feel free to join me in 30 Days of Mentoring. I will leave information below. And of course, I will see you back here next week.